All right. We are transmitting. So, Marnie, thank you for joining us again. You are in Qatar, if I'm not
In
wrong,
Qatar, in Doha now,
in
yes.
Doha. All right. So, last time that you spoke, I bothered you to speak at 6 a.m. And now I'm making you speak with us at 11 p.m., right?
That's it. That's it.
So
So,
I don't know how you're putting up with me, but I really
well,
appreciate the effort, Marty.
you,
The hours couldn't be worse, but I really
well,
appreciate you making the
well,
effort.
there's a payback time, and I'm looking very much forward to.
Yeah, I can imagine. I mean, you can make me speak at 3 a.m. in the morning. I won't be able to say no. So
Um, I think 3:30 is the
yeah,
absolute worst.
but Marty, that's the price you pay for being a globetrotter.
Absolutely, absolutely.
All right. So thank you very much for being with us again. And Nicholas, thank you for joining us also. So
Nicholas is
today,
also in Doha now. We are together here now in
oh,
Exactly.
Doha.
great. So
Exactly.
I'm making two people be awake at 11 p.m. All right.
Well,
Uh, well, so today we are going to be talking about tax incentives and Pillar 2 and interplay between both. Of
mhm.
course, one of the subjects will be the qualified refundable tax credits and non-qualified. And Professor Rene Matteotti is joining us in 1 hour or so, and he's gonna get into that subject. But we also have other issues that are important. So the interplay between SBIE and tax incentives, the interplay between planning and tax incentives, and there are a lot of globe features that will lead tax incentives to have one result or the other. And so Marnie is going to give us an overview on the subject, and then we'll keep on going with Rene. And then in the end, of course, we'll go back to with me to cover taxes. And I will going to adjust the cover taxes and their interplay with tax incentives again, which is something that we're probably going to see later today. Okay, Marnie, the floor is yours. Thank you very much for joining us again. And please.
Yeah, thank you very much indeed, Gustavo and Luis, Eduardo Schueri as well. It's a great pleasure being again with you, with the participants on site and online. And I'm also grateful that Niklas Kaiser is also joining me here in this session. Later on, Rene Mattiotti is coming. René is from Zurich, from Switzerland. We take a little bit also the Liechtenstein position with us. And therefore you get a kind of an Alpine Central European perspective on this global topic. Yeah, we are quite grateful to talk on also on incentives, tax incentives, because we think this is one of the probably crucial topics, and we can see again that we have a new kind of benchmark tax system with Pillar 2, with the globe rules on the table, because with regard to tax incentives, we see especially certain details how these rules are designed, which kind of tax incentives are, let's say, in the focus of being cancelled out, potentially cancelled out, because tax incentives have the potential to, of course, lower the tax burden. Otherwise, it wouldn't be an incentive, and not all incentives are treated in the same way. So there is room for differentiation, and so far there is room for planning in a way for companies, but especially for countries, how to design or redesign tax incentives. So if you can go to the first slide, please. Again, just to jump in, we're within that level playing field, within that one level playing field, or because of the globe rules, many countries, not to say over 100 countries, think about their corporate income tax system, think about the introduction of globe rules, but also think about the design and redesign regarding tax incentives insofar. So the level playing field these days has been and is a very active one, just to mention that again. So we can continue, and again, we see this interplay between headquarter countries, between operational companies, countries, and investment companies, finance companies, IP box countries, and so on. And there's a kind of a triangle also with regard to the question of allocation and shifting of profits, of substance, of tax. And also with that, of course, we are with a focus of tax incentives. We are in the middle of these discussion whether the globe rules really will end up with a curbing of tax competition, or rather boosting of tax competition. And from a perspective of tax incentive, we exactly want to have a closer look on that. So maybe continuing and saying hello to Luis. Great to have you, and great that we see us. Um, yeah, just to mention, and as an empirical data input, we see these days after the BEPS measures, BEPS 1.0 having been implemented, we see that in high income jurisdictions and investment hubs, more or less 70% of the profits of multinationals are booked. And we also see that in about 22% these profits are taxed with a maximum amount of 15% or lower. So profit shifting, lower taxation is of course a topic, just as a starting point, as a warm up for you with regard to what is the background of the globe rules. We discussed that already. Yes, so if we continue, and also with regard to the so-called race to the bottom on the one hand side, and this is still the case, and further on also with regard to how the taxes develop. If we go to the next slide, so we see countries who of course benefit from these kind of profit shifting, substance shifting, tax shifting. If we just have a look on Ireland, and this is not profit shifting in the way of pre-BEPS, but this is, if you want to say, profit shifting a way of post-BEPS. So one can discuss, of course, is this profit shifting? But what we see is that this process is continuing, and therefore, of course, topics like taxation of below 15% being on the stage, and also regarding tax incentives is, of course, on the agenda. So let's continue, and this taking always as a basis example, having an headquarter, the A parent in country A with an effective tax rate of 25%. The B companies in country B have altogether a 15% effective tax rate, so no problem. But the focus is on company C in country C having an effective tax rate of only 10%, therefore a top-up tax of 5%. This is our basic model, and if so, we refer to this model again, just to mention it again. Yes, please continuing, and and also maybe as a warm up to remind you, we have this benchmark tax system called Pillar 2, called the Globe Rules, including the statutory the subject to tax rule, the STTR. We have a clear tax base, we have tax rates, we have the corporate income tax system being a worldwide corporate income tax system, trying to prevent BEPS, but also to curb tax competition and to canceling out incentives, and what should better say, to cancel out certain incentives, because not all incentives, as already mentioned, are treated in the same way. And if you see this calculation of the effective tax rates on the bottom of the on the left hand side, then you see that most incentives, let's say these classical incentives, they are all regarded as reducing the covered tax, so reducing the effective tax rate. And if this is below 15%, then there's a canceling out of these tax incentives. And on the other hand, direct subsidies, grants, and also these so-called qualified refundable tax credits, so which is in a way not a tax incentive, it's just a payout of incentives, and you can deduct it first from the tax payments, but then countries have to refund it. And also marketable transferable tax credits, they only have the setup that they increase the globe income but not the covered taxes, so they have more or less no effect regarding the reduction of the effective tax rate. This means, of course, that we have an ambivalent effect on effective tax rates, taking into consideration, on the one hand side, classical tax incentives, and on the other side, direct subsidies, QRTCs, and the MTTCs, to name them like that. Yes, going further, and this is roughly the same with a little bit more focus on incentives, and we have this kind of the substance-based income exclusion, which is a kind of taking into consideration, if you want to say, tax incentives, but it's rather not incentives that are in the focus here, but rather a reduction, not of the globe income, which would be more systematic from an approach, but of the excess profit. So if we could just go one slide back, please, we see that in the determination of the globe income, there's no deduction of the substance-based income exclusion, but on the way to the determination of the globe excess profits, which are multiplied by the top-up tax rate, only insofar we have the deduction of the substance-based income exclusion. And if we go further again, we see that it is about long-term rate is about 5% of the carrying value of tangible assets, so tangible investments, rather old school investment, what could also say, and on the other hand, of payroll regarding employees. So a kind of, as the title is named, a kind of substance-based income exclusion. And substance, in the understanding of the globe rules, obviously is only tangible assets, investments in tangible assets, not intangible assets, and also paying of employees regarding payroll, which is, of course, I mean, that's the way the globe rules treat it. But of course, you could also, or one could have also thought about intangible investments in intangible assets, and on the other hand, the the reduction of globe income towards the excess profits is quite problematic, as we cannot deduct these amounts when determining the globe income. Having said that, and again, to focus well whether or not we have a so-called classical tax incentive, or rather direct subsidies, QRTCs, and MTTCs. Another topic, and this will become quite crucial with regard to which countries are affected in which way, and we try to keep a little bit in this session before René Matteotti will go very much to very, very precise details. So in that respect, it's quite important to mention again that there is a jurisdictional blending. And if we maybe just go back again to the example, the basic example we had before, then we see in country B, this is of course a kind of a successful blending between a company who has an effective tax rate of 5% and a company who has an effective tax rate of 25%. All in all, they have an effective tax rate of 15%. So check, the globe minimum tax rate is sufficiently reached in so far. So blending of different companies of a multinational group within a country is quite an important part of the application of the design of the globe rules. And we please go back to the slide we just have been. So blending has to be taken into consideration. The substance-based income exclusion has to be taken into consideration. And of course, also the question how tax incentives are treated according to the model rules, that has to be taken into consideration. And we need, let's say, all these three components to evaluate how certain incentives are impacted by the globe model rules. So next slide, please. Having all said, then we see, of course, and this is also a part of incentives, if you want to say so, because incentives can have a very different design. And of course, if tax incentives in a way, if we think about the benchmark system of GLOBE being a worldwide corporate income tax system, then of course any kind of territorial tax systems, and therefore offshore profits that are not taxed, are immediately cancelled out by GLOBE, and there's no possibility for any kind of safeguarding these non-taxation of offshore profits. The same is true with regard to certain competitive tax systems. Whatever makes a tax system rather competitive, let's think about an allowance for corporate equity, as we have, for instance, in Liechtenstein. Then, of course, if this leads to the case that we have an effective tax burden below the 15%, then, of course, also insofar there's an immediate cancelling out. In so far, although I wouldn't say an allowance for corporate equity is a tax incentive, but nevertheless, it's immediately cancelled out. And the same is true with regard to certain, not all, but certain tax incentives, especially the classical tax incentives being income or expenditure tax incentives like IP boxes, reduced corporate income tax rates, any exemptions, R&D super deductions, and all that. In principle, they are all cancelled out. The one which are not cancelled out are in the focus, and this is the focus especially on the qualified refundable tax credits, kind of a direct subsidy, kind of a grant we link to the tax system, although a qualified refundable tax credit is not really a tax topic. It's just an incentive the respective company can offset off the corporate income tax liability. And if it is even higher, then of course the countries have to do a refund over the levy of the corporate income tax. So it is, let's say, rather
Martin.
artificially linked to the corporate income tax. Yes, please,
Yes,
Luis.
Martin, just to understand, because you mentioned the question of territoriality, that's something which I had never thought. So get a country
Mhm.
like Uruguay, for instance. Oh, no,
Yes,
sorry.
exactly.
Get
Yeah,
any
yeah.
any European country, which has territoriality. That means you have this participation exemption, which means you don't tax income from abroad if it's productive income, generally speaking. And from what I know in Globi, you will not consider dividends as part of the company's income. It's deducted. So why did you say that territoriality would be a problem in Globi? I mean, imagine I have a company which is taxed on 30%, whatever you wish, but which does not tax profits from abroad because it adopts territoriality. And so the dividends coming from abroad are not taxed. But this amount, the dividends from abroad, are not considered in my income because they are deducted.
Yeah, yeah, yeah.
So
Well, Well, the
So
dividend the dividend topic is one topic, but the territorial tax system is, of course, going far beyond the participation exemption. And even European countries, let's take Switzerland and Liechtenstein, they have an exemption method called Steuerausscheidung for you, as you know, as you can speak German. They have an exemption for foreign real estate income and for foreign PE income
okay,
um, by the national tax code. And if we have a look on, for instance, Hong Kong and Singapore, then they go even further. So any kind of foreign source income, and I don't mean dividends, which come probably of a taxed company, out of a taxed company, but you can take foreign source interest, foreign
but
source royalties. And
Martin,
if this is, of course, not taxed in the company, being resident in a territorial tax country tax system, then of course this is a globe topic.
sorry, Martin, to discuss with you. You know, I like
Mm,
to discuss, and
absolutely, me too.
no, I would say, sorry, this is child's play. I mean, once you have participation exemption, whatever you have other income, which would be globally problematic, can be converted into a subsidiary. For instance, you get your real estate income, which would be tainted. Then you don't have anymore a real estate income. You have a company in that state, which will have its profits, and the profits will
Yeah,
be free. I mean, well, sorry, just to
yeah, yeah,
say,
yeah,
I, I,
yeah,
I
yeah,
once you
yeah. But
once you exempt once you the participation exemption, I can't see territoriality as a tax incentive in this sense. But Gustavo does not agree. He seems to agree with you.
no, no, no. But I mean, this is the one point. I mean, then it depends on the country where the subsidiary is located. What do they do? If they also have a territorial system, you assume
No,
that they
but
have a resident system.
no, just wait. Let me see, Shweta, if I got your facts straight. You're saying that if I got a UP in country A and a CE in country B, and country B has an ETR lower than 15%, and UP country A has a participation exemption, you're saying that that would be not be caught on a globe?
To say is that if I'm looking at the
Maybe
C's,
Niklas, we can
the
just
last
go to
one.
the calculation
The
of the
the C has it has a territorial system. So
one
that
more.
means it's not a problem in itself that the income from abroad is not taxable. I mean, because
Have a look here. Have a look here. Exactly as you say, you see the excluded dividends. I'm totally with you. But it's dividends. It's forwarded profits of a foreign company.
which is in
This
another
is
jurisdiction.
I wouldn't say the participation exemption is a classical example of a territorial system. What I mean is that foreign source profits, foreign source interest, who are received by a certain company, Uruguayan, Hong Kong, Singapore, that
What
these profits who are not taxed elsewhere, that these profits are not taxed in the country of a territorial tax system. Don't mix it up with the participation exemption.
because you're assuming that in case of participation exemption, the profits are taxed elsewhere at least,
Well,
which is another.
the assumption is at least could be the case, yeah.
Yeah, no, no, I can understand, but then you have at least it's another jurisdiction. I mean, in my it's not a problem for for jurisdictional planning as we are always considering the country itself. The fact that it grants an exemption, participation exemption is not a problem itself. I mean, because it's a sorry, it's a kind
Absolutely,
of it's a
absolutely.
kind of territoriality, the participation exemption, which
It
you
is,
adopt
but because it
and
is excluded in the
and
globe income, we
yes,
have to focus on the subsidiary and not
but
on the parent.
But as I mentioned, whatever income I have from abroad, which could be problematic, can be easily converted into a subsidiary, and then I can tax it. I can adopt the same participation exemption.
Yes, but then the question is, what does the subsidiary company
Okay,
country doing? Is
that
this
that
territorial? We have the same issue.
but the subsidiary, I mean, in the other country, well, it's taxed there. It's another jurisdiction. It's I mean, at least I can escape from in my jurisdiction, in the case of blending, I can. What I'm trying to say, I can't see the territoriality itself as a tax incentive, or at least not the same.
I'm totally with you. Don't misunderstand me. I'm totally with you. I wouldn't say territorial is a tax incentive, but Globe, let's say, understands it because Globe has a benchmark system, which is a worldwide corporate income tax system. And therefore, from a Globe perspective, this is a kind of a partially non-taxation. If we call it incentive, or if we call it coincidence, or if we call it that the national tax system is just not following the Globe benchmark,
But
that's a semantic topic.
But
But
participation
there's
exemption
a
is not the
difference.
case.
There's a
Participation
difference.
exemptions is
Participation
anybody
exemption
else?
is in a way a little bit a different case, because it is profits that have been distributed to another country, but they have been already potentially taxed in the country of the subsidiary. And of course, the dividends are excluded from the Globe income, so we cannot have the problem. I'm totally with you. Okay. So let's go further to I think it's exactly so what the picture we wanted, or we want to draw here, is to see that because of this benchmark system, it's not only tax incentives, for instance, that are addressed. It's also, let's say, certain measures that make a tax system more competitive, like an allowance for corporate equity, although the aim is to have a rather neutral tax system than an over competitive one. And also territorial systems are covered and are potentially cancelled out. This is the main story, and not the, let's say, the pure discussion whether a territorial tax system is a kind of an incentive. I totally share the view that this is not linked to something like a tax incentive. It's just a certain characteristic of a tax system, and also many worldwide tax systems have territorial aspects if we have kinds of exemption of foreign profits for different reasons, as already said. Well, yes. Coming back to the focus of the core incentive topic, we see traditional income expenditure-based tax incentive who are all cancelled out if the result is that they reduce the effective tax rate to an amount below 15%. And on the other side, we see direct subsidies, and especially the qualified refundable tax credits, also marketable transferable tax credits, who are more or less not cancelled out by Globe. So quite a different treatment by the Globe rules regarding, in a way of black and white, in regard of tax incentive traditional, and grants, subsidies on the other side, being not cancelled out. If we continue, please, then we see this kind of overview where we see, well, there is no impact, or there's an less likely impact of the Globe rules, or there's a more likely impact of the Globe rules. And I think we have to come back to that if we have a more precise view on how certain tax incentives are treated according to the Globe model rules. So going further in that topic, and there's this definition of qualified refundable tax credits, and also the marketable tax credits, transferable tax credits. And I would like to introduce Niklas insofar to make some comments about the definition, and also about certain more characteristic regarding the QRTC and the MTTC. Niklas, please.
Yeah, thank you very much, Martin. Also, thank you for having the possibility to speak here. It's rather late in Doha, but nevertheless, happy to share our research and happy to share what we do. I'm a PhD at the chair of Martin Wenz, and my focus is, among others, on the treatment of tax incentives on the globe. It's generally a globe topic, the interaction of globe and corporate tax systems. That's why this is basically my focus, and thank you for giving me the opportunity to share my thoughts on that. If we maybe go back one slide just to introduce what we are talking about now. It is basically on the right-hand side, we're talking about expenditure-based tax incentives. So tax incentives that target the expenditure side of the profit and loss statement, so to say. They don't target income, they target expenditure. And one particular type of expenditure-based tax incentives would be the tax credits. Those do not directly affect the net income of a company, but they affect the overall tax liability. So they don't target the tax base, but the final tax liability by granting a deduction of the final tax payable, so to say. And Globe makes a distinction in between, so to say, three different types of tax credits. We've got two, so to say, good ones and one, so to say, a bad one, depending on the perspective we're talking about. At least for jurisdictions, when designing their tax credits, they will, or most likely will, try to make their existing tax credits either a qualified refundable tax credit, a QRTC, or an MTTC, a marketable transferable tax credit. So just to motivate this here. Well, as I just said, those are the two types of tax incentives that most jurisdictions, competitive tax jurisdictions, or those that would like to become more competitive with regard to Globe, would aim for, the QRTC and the MTTC, because both of them are treated, you can see that on the right-hand side in the box, as an increase in Globe income. So they do not affect the numerator of the ETR calculation. As you've seen before, the numerator is to cover taxes, but they affect the denominator. So they do not reduce the numerator, they do not reduce cover taxes, but they are treated as Globe income. So they are treated as an addition of the denominator of the ETR calculation, and later on also, that's the negative effect maybe, but that does not outweigh, or usually does not outweigh, the positive effect that stems from being treated as income in the ETR calculation, will also increase the tax base, but when of Globe, but when looking at the ETR, the impact is less strong. So the ETR remains rather high than in comparison to non-QRTCs, non-MTTCs, and other tax credits, because they are treated as a reduction in covered taxes. Because like a reduction of the numerator, given that the numerator, meaning covered taxes, is usually lower than Globe income, will less negatively impact, or will more negatively impact the ETR than an increase in the denominator of the calculation, which would be caused by the QRTC or the MTTC. So first of all, what is a QRTC? Here's the definition. It is a tax credit that is generally refundable. When is it refundable? Within 4 years from when a CE that is subject to Globe satisfies the conditions for receiving the credit under the laws of the jurisdiction which grants the credit. So the basic criteria is refundability within 4 years. You can see that on the right-hand side on top. Whenever we got refundability within 4 years, well, we might have a QRTC. Refundability means, well, it needs to be available as cash or as cash equivalents, whatever that means. That can be Bitcoin, for example. That can be something else than cash. If, for example, the corporate tax liability of a year is not sufficient to be reduced more than zero, for example, the rest of the credit must be available as a payout within 4 years from when the CE has been granted the credit. So basic
Nicholas,
criteria, yes.
Just 1 second about this definition. You
Yeah.
think a qualified refundable, well, a tax credit based on income, even if I do it or I write the law in a way that it's a cash grant and the person can get a cash grant, but if it's based on income, like, I don't know, 10% of the corporation's income, and my corporate income tax is 20%, even though I write in the law that is refundable, that'll never occur because the incentive is based on income. Do you think it would be qualified as a QRTC, or that's out of the question?
I would not say so when thinking about it now, because like a QRTC, it is treated then as income. The amount of QRTC granted is treated as income, but the QRTC itself, the amount of the credit, must be calculated with respect to expenditure. That's why
Yeah,
it's
that
basically.
Yeah, if it's an expenditure incentive, then I don't know if it's based on the investive on effective fixed assets or something like that. Then I can
Mm,
conceive a situation where the company might be running at a loss and get the money back. So that would be the typical qualifying situation. But I was
definitely.
wondering if anybody has written, because I don't remember seeing anything on the definition that says, well, it can't be an income-based incentive. It seems pretty obvious that that will frustrate the whole thing, but I don't
Mm,
know if there is something that clearly says that, hey, you cannot do an income-based incentive and want to qualify it as a QRTC.
mhm. It would then have the same effect as a partial exemption, but I see where
Exactly.
you're going. I see where you're going in the end. Mm, but I also don't remember to, it's implicitly assumed in a sense, because we would have that circular thing when basing it on income. So I don't think this would meet the Q. This would be considered qualifying. But a good point nevertheless.
Thanks. I was wondering if I was going crazy or if this was actually an issue. But it seems to be a no-brainer that it shouldn't qualify. It just amazes me that this isn't clearer on the definition.
I also have never read anything that would bring up that thought. I can't remember at least.
There's a paper by Vikranshan that kind of touches the issue, saying that he thinks that that wouldn't qualify, but it doesn't go further than that, I guess.
Okay. Okay. Well, I'm of the same opinion. Yeah. Okay. Yeah, thank you very much for that input in that sense. Well, QRTC, as I said, it's all about refundability and refundability in full within 4 years, available as cash or cash equivalents. But there's also another a tax incentive which can be treated as globe income, which is the marketable transferable tax credit. It's not included in the globe rules as we know them, but it was just later specified in the administrative guidances for the globe rules. The main criteria for the MTTC is not refundability, so it must not be refundable. You can see that on the right-hand side again. It doesn't matter. It only has to be marketable in a sense. And in that case, the tax credit, which must not be refundable, must meet two criteria, which is the so-called legal transferability standard and the marketability standard. I will go into more detail on the next slide because those two standards differ from the originator of the credit, the entity that has been granted it in the first place, and the purchaser of the credit. Of course, when it's marketable, there's someone who can purchase it. So those are the two standards that have to be met to be considered a marketable transferable tax credit. So it's not about refundability here. It's all about being able to sell and buy it. Yeah. All other types of tax incentives would not be considered globe income. They would be considered a reduction in covered taxes. And yeah, as I tried to explain before, their impact on the ETR is higher in a negative sense, meaning that the top-up tax rate of non-QRTCs, non-MTTCs might be considerably higher, therefore leading to a larger impact in terms of top-up taxes payable. If we continue on the treatment of the marketable transferable tax credits that have just been, so to say, introduced by GLOBE administrative guidance with regard to especially or particularly the USA that make use of those credits to a huge extent. Well, the treatment of the MTTC differentiates or is different for the originator, the entity that is first granted the credit by the legislator, and the purchaser, because of course it's a marketable credit. So when we look at the originator, upon receiving the MTTC, the so-called face value of this credit is added to GLOBE income. When sold within 15 months to the purchaser, the sale price is added to GLOBE income. So those are all possible variations on what can happen. For example, if of course it is sold, well, it's not the face value that counts, but it's the sale price that counts as GLOBE income. And if the sale occurs after more than 15 months, the difference between the face value and the sale price is then treated as a reduction in GLOBE income. So this is basically what happens here in case of the originator. When looking at the purchaser, well, we also have different possibilities. For example, the purchaser can not use the MTTC, so it expires without any use. The purchaser can once again resell the MTTC, it's a marketable credit, or can use it like it's supposed to pay the tax liabilities. When that's the case, so the very first one, to pay the tax liabilities, the difference between the purchase price of this purchaser and the face value, the original face value, is added to or subtracted from GLOBE income, depending on if the result is positive or negative. When it is resold, so sold again, the difference between the new resale price to the second purchaser, so to say, and the purchase price of the first purchaser is treated as an addition or a reduction to GLOBE income, depending on the situation, if this is a negative or positive amount. And when it expires, well, the portion that expires, maybe all of it, is treated as a reduction to GLOBE income in the fiscal year of expiry. This is, of course, a very technical analysis, but this is how it would be performed under GLOBE. Of course, the treatment of a QRTC is way easier in a sense. Well, whenever the QRTC is granted, it is considered GLOBE income, and that's it basically. For the MTTC, of course, it's a bit more complicated, and the administrative guidance here you can see that is not unclear, so to say, but provides for a different treatment depending on when the resale occurs on part of the originator and also on part of the purchaser when it comes how to use the credit or how not to use the credit in the end. And yeah, with that, I would continue with the next slide and potentially hand back to Martin.
Yeah, thank you very much, Niklas, for the details regarding the QRTCs and the MTTCs, and now I think we can take all that that you have mentioned, and I think that's very important, as you have mentioned it, to see the impact of GLOBE on these tax incentives. So we see with that, of course, everything that takes the effect of an effective tax rate below the 15% leads to a top-up tax, whatever is the reason for. And if we continue, then of course we see different kinds of and again all these measures lead to a canceling out might be covered partially by the substance-based income exclusion, but there isn't canceling out, and I think that's it. So of course, also with regard to these kind of tax incentives, we see a floor regarding tax competition, curbing of tax competition. Going ahead, so the case, for instance, with regard to incentives of countries with a corporate income tax burden that is below, or that is above, better to say, the 15%, there might be some room for having these classical tax incentives. And if we go further, then we see, for instance, with regard to Ireland, that the redesign of their so-called knowledge development box, which is something like a broad IP box, of course, has certain effect. But if you have a look on the right-hand side, then regarding entities in scope of globe, so the one we are looking for here, of course, everything that is not levied by the respective corporate income tax rate, which is 10% here, is to be top upped by these 5%. So this kind of tax incentive with regard to Pillar 2 has no effect. So giving the tax incentives leads to a top-up tax and has no further impact. Going ahead, then we can compare, of course, the situation of rather low tax countries, as already mentioned, Ireland. They have no possibility of cross-border BEPS, and they have no possibility of domestic BEPS. On the other hand, if we have a look on France, offering an IP box with a tax burden of 10%, and usually ordinary profits are taxed at 25%, then of course we see the possibility, and this has been mentioned before, of blending. And the effect can be, of course, to use a very classical tax incentive, an IP box, to generate these, I would call it, premium profits, and the premium profits are rather high. As with IP rights and the use of them, one can earn rather high profits, even industrial groups, on the one hand side, and ordinary profits on the other hand. And you can see here just a mixture of 2/3 of the profits are these preferred profits, preferred taxed profits even, with a corporate income tax rate of 10% according to the IP box, and 1/3 of the profits are ordinarily taxed profits, taxed at the level of 25%. And of course, we see there is no cross-border BEPS, but there's domestic BEPS. We see blending, and we end up in a corporate income tax rate, an effective tax rate of 15%, and incentives, classical incentives, reducing the effective tax rate, are not cancelled out. And of course, this is clearly in favor of large countries. This is in favor of countries who can offer also ordinary profits and who can also offer preferred tax profits. And one could state insofar that the introduction of globe might even boost tax competition and not floor tax competition, but from the other side, from a tax burden of being above the 15%. And if you continue this picture, then we also see that, for instance, the same effect with a Dutch IP box and ordinarily taxed French profits is not possible to achieve, but only in a domestic, so-called domestic BEPS situation. And if we further continue, then we see also the case of Ireland again, not with regard to its knowledge development box, but with regard to R&D tax credits being a qualified refundable tax credit, and that insofar we see, of course, the result that this refundable tax credit for R&D investments, that insofar there is a kind of a top-up tax, but the top-up tax is of course much lower than the top-up tax of a classical tax incentives. So for Ireland, it would be clearly preferable to introduce more kinds of qualified refundable tax credits like these R&D tax credits versus the use of the knowledge development box, but of course in situation when the companies are covered by a globe. Of course, this is not the case if we have not a globe covered company, so therefore maybe even for Ireland it makes sense to have both incentives still in place. And if you continue, then we see, for instance, the Swiss super deduction, R&D super deduction, which is a kind of a classical tax incentive, and we see, of course, that all that has not been levied insofar is cancelled out by a top-up tax. So insofar with regard to in-scope globe multinational enterprises being located in Switzerland, it's of course not preferable to use these tax incentive. It's entirely cancelled out by a globe. And if you further continue, then we can get a kind of a picture to see, well, where are these QRTCs already in place or under consideration? This is not the full picture. This is kind of work in progress. But of course, in European Union member states who are kind of a front runner of the implementation of the globe rules, they are also of course, kind of front runners with regard to the introduction of certain QRTCs or taking into consideration the introduction, the implementation of certain QRTCs. Well, summing up, the question, of course, may arise: which countries, jurisdictions should take which action with regard to the redesign of tax incentives? And we have here 4 groups: high income jurisdictions, being also high tax or low tax jurisdictions on the one hand, and low income jurisdictions being high tax or low tax jurisdictions. And of course, quite interesting is the box of being a high income jurisdiction and the low tax jurisdictions, because these are, let's say, the active tax incentives countries for certain preferred profits, premium profits, like intellectual property rights profits, and so on. And the issue insofar is that for these countries and jurisdictions, usually the introduction of QRTCs and MTTCs or just grants is the preferred mechanism for designing tax incentives. And with regard to high tax jurisdictions, being also high income jurisdictions, that all types of tax incentives might be of a certain effect, as these countries and jurisdictions can offer usually also the method of blending ordinarily tax profits, high tax profits, and preferably tax profits, like we have seen in the example of France, for instance. Yeah, having said that, I think we have some room for questions, further questions or comments before we give over to René. And I would ever be so happy if you have any questions, comments, or would like to discuss further topics insofar.
Thank you very much, Martin. One thing one of our viewers pointed out, and it's true regarding the issue that I posed, and I put on the chat on Zoom, but it's not everybody that can see it, is that the commentaries, paragraph 136 on the commentaries of the qualified refundable tax credit, it kind of gives away that when it says, however, in order to be treated as QRTC under the globe rules, tax credit regime under the laws of a jurisdiction must be designed such that the refund mechanism has practical significance for those taxpayers that will be entitled to the credit. If the design of a tax credit regime is such that the credit will never exceed any of the taxpayer's tax liability, or it's intended that the credit will never exceed any taxpayer's liability, then the refund mechanism will be of no practical significance to the taxpayer, and the GloBE rules will not treat the credit as a qualified refundable tax credit. So I think that really buries the example that I was posing of a credit that is only contingent on income, because it will never qualify for the mere fact that there will never be a situation where it would be refundable even though you write it on a law.
Always somebody could say, come on, income is one thing, tax base is another thing. If you base on the income but not on the tax base, never is a very strong word.
Yeah, but never know when de facto non-refundable will become a non-qualified. But yeah, I think it's a dangerous path to go, and if it never hurts the government in a sense that they would need to give money away at one point, it probably wouldn't qualify. So I think it has to have a certain budgetary impact that is not only revenue foregone. I think that's the thing, but still to be seen.
And this is also the idea of it.
Yes. First, of course, I agree with you, and I was making it just as an argument. But the question which I have not seen Martin discussing here or you discussing here is the idea behind it. Why is it different, a refundable credit from a non-refundable? I don't no, I'm not asking what's the difference. I'm asking from a substance. Why are they making this differentiation? Why is it different if I get a refund or not? What's the difference between one or the other? Why is one free or not? This is thinking which I think we should understand from this course.
Well, there are some things that I think we consider. First one is from a if you take a look from the mechanism of the tax incentive itself, if it's a profit incentive or if it's an expenditure incentive, and we just proved that profits incentives wouldn't work in the sense, and it has to be a kind of an expenditure incentive, or at least some incentive contingent in something that is not a profit, but usually an expenditure incentive. And if you look at the differences from a policy standpoint, there is much more meat on an expenditure incentive than on a profit incentive, meaning that you actually do something that is contingent on activity and not something that is contingent on just profit shifting. So it kind of goes with the SPII thing that if there is actual activity over there, then an expenditure incentive really goes to show that you're doing something that is contingent on bringing something. So that's the first point. The second point, a sole revenue foregone incentive is much more prone to harmful tax competition than an incentive that touches budgetary issues that you really need to put your money over there. Because if a revenue foregone incentive will always be contingent on the profits that you bring and profitable activities that you bring. If you're putting money there, then it's something else. But Shwedi, I think he doesn't agree, so I'll get the word back in.
I do partially.
Well-
I do partially. I was just sorry, Martin. Just to think here, something which you said, Gustavo, which is correct. When you have an incentive based on tax, you only incentive profitable activities, and as far as there are profits. When you have an incentive which is not profit, which does not relate to profits, you incentive the activity irrespective of it being profitable or not. This could be a good argument. Say it's different from a. I mean, at least you you're looking at the investment and not the profits of the company. Martin, I'm just mentioning this because we have in Brazil, or we usually have, and maybe will be changed or and so on, we have several incentives based on profits. For instance, everything which you have in our free trade zone, it is based on the profits presently, maybe change it. That means if you have a company which decides to invest in the north of Brazil, this company may have an incentive or not, depending on whether it has profits or not. The company can go there and say, wow, this was a bad deal. I'm not making profits. And if it's not making profits, there is no incentive. The incentive is, and the other way round, and the other way round is that when you have an incentive based on profits, there is no correlation between the amount you invest and the amount of the incentive. So maybe it would be better, clearly better, to say that an incentive which may be accepted is when there is a clear relationship between the effort of the taxpayer and the benefit it's having. The benefit in the sense that I'm reimbursing your investment, not more, not less. So this would be, I think, this makes sense from a policy. I mean, it's better from a policy perspective for a country. Yes, there's a reason to say, well, I'm just reimbursing or I'm internalizing your externality. This is true for the case of expenditure incentives, but this is not true for profit incentives. So this would make. I'm just trying to understand what could be behind it to say there is a difference, and I agree with the difference. So to say, because the question of tax competition and so on, well, incentive is also kind of helping for competition. But usually you can find at least the idea of this clear relationship, so to say. So that means no problem if you internalize externality. But there is a problem if there is no evidence that this is what we are doing. Maybe just for this group here to think about the rationale, what's happening here.
I think maybe the rationale we can even put to ease it in a way, addressing what Gustavo already mentioned. That I think the incentive leads to the case that the respective country really has to put money on the table. So if the corporate income tax burden is not sufficient, then there has to be cash outs. And I think this is what is meant with the term refundable. And of course, this shows how close these QRTCs should be with regard to grants, with regard to direct subsidies. So in a way of other forms of a direct subsidy linked to the tax system, although a QRTC, I would say, is not a part of a tax system because it is just a deduction of a tax burden. And if it's not sufficient, then you have to do a payout. So you can say, well, what has this to do with the tax system? But just it is the mechanism used of the tax system and all the system doing refunds, and you can use that mechanism, but it is not a part of the tax system. Even you can do it if you have no tax system.
Yeah, I fully agree, and you know that putting your money where your mouth is, it's relevant. Shreddy, I mean, the distinction that you made is supported by a lot of economic theories, saying that the expenditure incentives are really better on pursuing the goal that you want with the incentive than profit incentives that are usually not good. But the thing that if you have a budgetary risk means that you're willing to give money away for that activity, even if you don't have a tax revenue that goes with it. So it really makes you, well, I'm incentivizing something. Whereas if you have a profit incentive, which is only revenue foregone, you can easily be doing an incentive that will only be good for somebody that is doing profit shifting, which is something that we have on a state level here, that you give an incentive just to attract fake activities that you wouldn't have in the first place. Because they're contingent on tax revenues, and it goes only up to zero. If that's not the case, well, then I want something actually coming here, because I might have to spend money for it. So if I'm spending money for it, it has to be something that is other than just profit shifting here. So
Of course, I can understand that when you get the text, they're talking about refundable, not refundable. So you're correct in the end. Yes, that's what they did. I'm asking what they are looking for, because really it's very difficult for me to say that there's a difference between not getting taxes or paying on the other side. I mean, it's just a question. This is a cash flow argument, and I don't accept a cash flow argument, because come on, it's the same if whether I'm not collecting taxes or whether I'm paying you, because it's the same. But the other argument, which is the one which said economic, which is the externality, this makes sense. I mean, what I was mentioning is maybe there is here a loophole. I mean, it could have been better explained.
all right. Anybody else? I see that Renee's already here, and I don't want to go too much into the time we had agreed with Renee, but if anybody else has a question to Martin, it's past midnight for Martin and Nicholas, so I don't want to keep them also. All right. Martin, Nicholas, thank you very much for being with us again, and it was a pleasure, and thank you for your presentation. And you're welcome to stick around if you have insomnia, but you're also very free to go to sleep, because I know it's midnight there.
Yeah, thank you very much, Gustavo. Thank you, Luis, Eduardo. As usually, great to be with us, and we directly jumped into certain discussions. Yeah, what a pleasure. All the very best to all participants. For finalizing the course on Globe. I think that's a brilliant idea you brought here on the table, Gustavo and Luis, and well, have fun with Renee. Great to see you. I don't know whether you're in Zurich or the US or wherever. We shared this session from Qatar. And yeah, I wish you all a very nice evening and a very interesting one. And probably Renee is now going very much into certain very interesting details to make this picture even more clear, I think. As we did in the first hour here. Thank you so much. Thank you.
Thanks,
Also from my
Martin.
side.
Bye-bye.
Thank you so much.
Bye bye. Bye bye.
Goodbye. Thank you.
Hi, Renee.
Hello, Gustavo. Hello, everyone.
It's a pleasure to have you with us. So Professor Renee, professor at the University of Zurich, but right now on New York City at NYU. So Renee, really nice to have you here. Thank you for accepting our invitation. And Truedi?
Yes, now I need to find my presentation. I'm not sure whether it's already, I think this is a mistake. Maybe give me some seconds. I need to open my presentation. Now I think I made a mistake. 1 second, and then I will come back. I need to open the presentation quickly, but this shouldn't take too much time, actually. I forgot it to open.
In the meanwhile, René, just to thank you for being with us. René is present. He's a professor in Zurich, yes, but presently he's a professor in New York University. He's the global Hauser professor. This is, I must say, when I talk to René now, it's for me even better because I've been in this position and I have such a good memory of the time I was in New York teaching in NYU. So allow me to say really a bit of envy also to imagine the nice time you're having there. And thank you for, I know how busy you are because of your activities there. And thank you for sharing your time with us also.
This is
Uh,
a great pleasure actually to be with you. Now I just need to find my slides.
are you being in April in New York also?
And yes, absolutely. We should see
Okay,
each
because
other
there will
here.
be the
Yes,
Brazilian. You know that there's going to be a meeting, the Brazilian Day in New York on
yes.
April 7th. I'll be there.
Okay, so we are going to meet each other in New York. This would be fantastic. Now I have so many presentations here on my desktop. Now I found it. Oh my God, yes, this is good. I should have prepared that already in advance. Sorry for that. Now let's open this one. All right. I hope you can see my presentation now. Can you see it?
Yes, I just mentioned because I now saw that Vittoria is also there. Vittoria is organizing this meeting for you to know. She's also at your side there.
Yeah. Okay. Okay. Now let's
We
see.
we still can't see it on full screen,
Yeah,
Rene.
is it
Yeah,
now?
there you go.
Is it
There
good?
you go.
Okay.
Perfect.
First of all, thank you very much again for the invitation. It's really a great pleasure to speak about tax incentives and qualified tax credits. I noticed that you already had a very interesting and good discussion. So one of the topic or issue that you raised is actually also one of my major concern with respect to the entire global minimum tax rule world. And I can just echo what you already discussed and said. I hope that my presentation will not be too simple now. I don't know exactly what you already have discussed. If it's too simple, then at least it might be a valuable review of what you already discussed. And we can, of course, also go in great details when it comes to specific topics. Just to wake you up, this bird here has a significance insofar that this bird is a Swiss cartoon hero who explained to the Swiss kids the world. He's very popular for good night story, a very good night storyteller. And I think this bird fits quite well to the topic we are going to discuss now in the following. First, the most important thing is his name is Globy. Globy, such a coincidence. And secondly, as I already said, he's a good night storyteller. And I'm not sure if I look at the pressure coming from the new administration in the US, whether Globy might become a good night story. At least if you read the model rules, you will fall asleep quite quickly. I'm pretty confident and sure about that. But now let's become serious. This is the agenda of my presentation, and I would like to stress you can ask questions at any time. The more interactive the talk is, the better for me. But it's really up to you. We can also have the discussion later on. So I would like first to categorize the tax incentives. I have the impression that you already spoke about that, so I will just give a quick summary, quick overview about the various tax incentives. Then, of course, we speak about, I'm going to speak about the distinction between courtesies and non-courtesies under the current global model rules. Does this distinction make sense? I noticed that you already spoke a lot about that, and I totally agree with what was said in this regard. But I'm going to spend some words on this distinction again. Then, of course, what is relevance of the treatment of the cure disease and non-cure disease for the calculation of the GLOBE income or loss for the calculation of the GLOBE income or losses under the model rules. We are going to have a look at the specific provisions which guide the calculation. And then I would like to spend some time about the significance of the so-called no benefit requirement. This no benefit requirement is extremely important because it has an impact on the question whether a domestic minimum top-up tax is recognized as a qualified domestic minimum top-up tax or not. And this is key. This is key for the business community. And the same is true with respect to the qualified income inclusion rule. These qualified income inclusion rules are not so important for investment hubs like Switzerland, but nevertheless, the no benefit requirement is also applies to the IIRs. Then I would like to have a look at the EU foreign subsidies regulation. This is an instrument of the EU to protect the common market, and I think this might be important in case that the model rules fail. The EU will have another instrument to fight unfair tax incentives and so on, or tax incentives or grants. So, and then I will conclude my presentation with some policy recommendations. So let's have a look at the different categories of tax incentives. You spent already some time on that. This was my impression of the discussion you had with Martin. I couldn't actually listen to Martin, but I guess you know this graph already. The OECD distinguishes between income-based incentives and expenditure-based incentives. Income-based incentive are incentives which fully exempt or partially exempt profits, or which provide reduced rates with respect to a specific item of income. A typical example for income-based incentives are patent boxes. Patent boxes are very spreaded, and patent boxes allow a special deduction on profits arising from patents or similar registered IP rights. And as already mentioned in the discussion before, they allow companies, MNEs, actually also to get tax benefits for so-called residual profits. I mean, IPs are the drivers for generating residual profits. And the OECD was always very much concerned about patent boxes. They allowed patent boxes in the strict framework of the recommendations of Action 5, but nevertheless, the OECD has never been very friendly to patent boxes. And we will see that these patent boxes won't work anymore for multinationals. This was just one example. Another example are tax holidays, where government actually provides a full exemption or partial exemption from taxation of profits generated in a specific zone or with respect to a specific activities. So then we have the tax deductions. Tax deductions are expenditure-based incentives. And I fully agree. From a policy point of view, tax deductions or which are expenditure-based might make more sense because they are not so vulnerable with respect to profit shifting. This is the reason that the OECD is much less concerned about such tax deductions. But again, they are nevertheless not treated as beneficial as qualifying refundable tax credits. Then we see the tax credits. Tax credits just means that a taxpayer can deduct a specific amount, the so-called tax credit, for the taxes to be paid. So these are the various instruments. And if you look at investment hubs like Switzerland, we work a lot with income-based incentives. Patent box is key, tax holiday as well. And there is a simple reason. We just want to actually promote successful multinational, successful companies. We don't want to fund somehow companies which are unsuccessful on the market. This is one reason. And then, of course, budgetary risks. Budgetary risk. If you don't have to spend money for less successful companies, profitable companies, government is less exposed to budgetary risks, and in particular, they get the approval by politicians, lawmakers, and the population. We have a direct democracy in Switzerland, much easier. So now we had a look at the left-hand side of the graph. Let's have a look at the right-hand side of the graph. For this purpose, I think it's important to dive into the Global rules quickly. You find the relevant provision in Article 3, paragraph 2.4 of the Global rules. Article 3.1 sets actually the starting point for calculating the global income or loss. Article 3.1 just says that the financial accounting net income or loss is the basis for determining the global income or loss, but this income or loss as calculated in the financial accounts need to be adjusted for the items which are described in the model rules. And here Article 3.24 kicks in, which stipulates qualified refundable tax credits shall be treated as income in the computation of global income or loss of a constituent entity. Non-qualified refundable tax credit shall not be treated as income in the computation of global income or loss of a constituent entity. What does this mean? This means maybe let's have a look at the definition of the QRTC. This is the acronym that is generally used. The definition is in Article 10, paragraph 1.1 of the Global Rules. Qualified refundable tax credit means a refundable tax credit designed in a way such that it must be paid as cash or available as cash equivalents within 4 years from when a constituent entity satisfies the conditions for receiving the credit under the laws of the jurisdiction granting the credit. So the qualified refundable tax credit is a kind of refundable tax credit which urges governments to pay out the tax credit if irrespective of whether this tax credit can be used against taxes to be paid or not. Irrespective of that, after 4 years, the government has to pay. This is the key here and the problematic issue. This is an arbitrary line which the Global Rules actually draw. I fully agree with everything what was said in the discussion before. Then what happened? These are the Global Rules. In the OECD commentary, the inclusive framework extended Article 10, paragraph 1.1 to so-called marketable transferable tax credits, so-called MTTCs. There's a definition, MTTC means a tax credit that can be used by the holder of the credit to reduce its liability for the covered tax in the jurisdiction that issued the tax credit and that meets the legal transferability standard and the marketability standard in the hands of holders. So you need to be entitled to transfer this tax credit to another person. So there must be a legal provision which gives the right to the holder of this tax credit, so you can deal with these tax credits, and then a market needs to be set up for such MTTCs. So why do we have this extension of Article 10, paragraph 1? It's a typical example for amending the model rules through the commentary, actually, because this has no legal basis in my view. It's just a compromise which the inclusive framework had to enter with the United States because of the US green tax credits, which were introduced by the IRA, by the Inflation Reduction and tax. They wouldn't have worked anymore in the global world, and because of that, the OECD inclusive framework found a compromise with the United States, and they expanded the scope of the QRTCs to the US green tax credits. So whether this makes sense or not, it doesn't really matter. It's a compromise among powerful countries. Of course, as a Swiss, I'm not so happy about that, because when we have some issues, then usually it becomes very difficult to find a compromise. But let's leave that aside. So what does it mean now if we look at the calculation of the top-up taxes? Actually, you already know this chart or the mechanism how the top-up tax is calculated. If you have a QRTC, if a government grants a QRTC, you are in the green, you're in the field with green letters, global income. This means, as I said before, the global income gets increased by the tax credit, qualified refundable tax credit. And if you have a non-QRTC, a tax credit which doesn't qualify as a QRTC, or if there is another tax incentive which is profit-based or expenditure-based, but which just grants a deduction from the profit, and there is no cash out, then you get into the problem that your covered taxes get directly or indirectly reduced. And if this happens, then of course your ETR, effective tax rate, will get reduced, and the top-up tax, which can be levied in a foreign jurisdiction, might become higher. This is the reason that it's so important that your tax incentive qualifies as QRTC under the global tax rule. Now I must look at the time. Gustavo, you interrupt me if I have to finish. So now
we have time. Don't worry.
This is the reason why it's so important. Patent boxes don't work anymore. They trigger indirect reduction of covered taxes. This is the reason that it won't work anymore for multinationals. And the same is true for tax holidays and so on. There is an exemption which is very important. The top-up tax is imposed on the so-called excess profit. This means the global rules itself also grant some incentives. One important incentive is a substance-based income exclusion. And then there's also a very funny exemption for income from international shipping, because many countries have introduced so-called tonnage taxes, and somehow the industry got hurt by the OECD, and they introduced this exemption. Also something very arbitrary in the Swiss parliament. This is just a side remark here. The introduction of a tonnage tax was discussed in the parliament, and the majority in the parliament said, no, we are not going to do that. This is totally arbitrary and it violates our constitution. But we have such rules and regimes in the model rules, and this is in my view problematic, because if you have something like that, there are some question marks about the legitimacy of those rules. But let's leave that at the side. I just want to say, if you are within the substance-based carve-out, then of course you can still apply any kind of incentives. You can grant a tax holiday. You can use a patent box. This won't have a negative impact. So this means the patent boxes may still play an important role in the future for all companies which are not within the scope of Pillar 2. The same is true for tax holidays or for the subsidies granted upon discretion by the government. And of course, I said already, if you get a QRTC, then this might increase. This increases your profit. This increases your profit, and probably it might be in some cases that if you have to include the QRTC as a profit, that you actually exceed the substance-based income carve out, and then become liable for the top-up tax. And then, of course, there might be interesting discussions about how much such QRTC nevertheless is beneficial or not. I'm not going to touch upon that. We would need to demonstrate that by using some example. But these are the main elements that I wanted to show you. Now, I mean, with respect to the policy, does this distinction make sense? No, it doesn't make sense at all. I fully agree. Why did the OECD introduce such arbitrary rules? I don't know it, but I know that the example for QRTC was found in the French tax law. And we know that France was one of the drivers of the minimum taxation, and they wanted to safeguard this QRTC. And this R&D tax credit in France is super successful. I hear from many multinationals that they can benefit a lot from that. It's a very generous R&D tax credit, and France was able actually to defend that, and maybe they offered the blueprint for the global rules in this regard. There's another problem we have, and I think this is something that I also see in Switzerland. I'm advising some cantons on the introduction of such incentives, which is very, very difficult. You will see that afterwards, why. And they always say that our biggest concern are the budgetary risks. We have to pay out money, and people want to know who gets the money. I mean, sometimes these are enterprises which are chaired by famous politicians in Switzerland. So this is very, very difficult. You have to actually provide some transparency to the public. If you grant if you pay out money, tax money, and this is, of course, contrary to the tax secrecy that we have in Switzerland, but for subsidies, there are different rules. So this is a major concern we have. And I also think that the policy of the OECD is totally misguided. Why should we put jurisdictions at budgetary risks if they want to incentivize R&D activities, or if they want to grant green tax credits? I don't understand that. This means such incentives are for big economies like France and Germany. Maybe they fit to such economies, but they fit less actually to developing jurisdiction, or in the case of Switzerland, to cantons. The cantons are responsible for designing the economic policy, and they have just less revenue that they can use for such measures. So I fully agree with everything. It's totally wrong, and we should go to another direction. We should actually incentivize activities which have spillover effects, like R&D activities. This makes sense for me. And of course, also where we have a market failure, maybe with green tax credits, I also see a field. But again, these are just some consideration and thoughts on the current rules. So let's now move on to the no benefit requirement. Why is that important? Jurisdictions, all the countries that adopt the global minimum top-up taxes, they have to make sure that they don't introduce measures which may undermine the policy goals of Pillar 2. So, easy example, you levy a top-up tax in line of the Globe rules, but at the same time, you return this money back to the MNEs who paid the top-up tax via tax incentives or even via qualified refundable tax credits. The OECD, of course, discovered this weakness, and they provided a definition for a qualified domestic minimum top-up tax. You find that in paragraph 116 on Article 10 of the commentary. I read it quickly. The tax must be implemented and administered in a way that is consistent with the outcomes provided for under the Globe rules and their commentary, including the prohibition, this is now key, against the implementing jurisdiction providing any collateral or other benefits that are related to such domestic tax as discussed further in the commentary to the definition of a qualified IA. So benefits related to top-up taxes are prohibited because they pose the risk that the entire integrity of the global minimum tax gets actually undermined. The question is now, what does the phrase related to such rules means? If you look at the commentary, you don't find so much guidance on that. I would say the commentary provides you with the true extreme end of the scale. The commentary says benefits which are granted to MNEs which pay top-up taxes are clearly prohibited. This is here symbolized by this red box here on the right-hand side. And then the Globe rules also says, but a tax benefit or granted provided to all taxpayers is not related to the Globe rules. So if these tax benefits are not selective, then they should be fine according to the current commentary. But now, what happens with tax credits which are granted on a discretionary basis or which are based on selective criteria, such as profit or such as a specific threshold amount that needs to be exceeded for getting the benefit. The Globe rules don't say anything about that, and this is the reason that the OECD announced the publication of an administrative guidance on related benefits. Last year, they said that they will issue this admin guidance by the end of 2024. In the meantime, they say that they think that they are able to issue this guidance by summer 2025. I don't believe that this will happen. You know, the inclusive framework works on a consensus basis. We don't know what happens with the United States. If they walk away, then there will be no consensus in the inclusive framework, and there will no further admin guidance anymore. And the entire uncertainty remains as it is, which is, of course, very bad for multinationals not based in the United States. So I would also like to point out at the last paragraph of this sentence, the OECD also says that when checking or when assessing whether a domestic minimum top-up tax or IIR is in line with the global rules, they also look at any political subdivision, local authority, or any other public entity or arrangement which grants benefits. This is very important. I'm sure this is directed to Switzerland because the cantons have a huge autonomy and they are allowed to give incentives to multinationals. And if one canton grants benefits which violate the no benefit requirement, then the entire Swiss implementation of the domestic minimum top-up tax might fail, in the sense that the Swiss DMTT will not be considered as qualified. And the qualified status is very, very important for multinationals. What is the benefit if you are qualified? If a DMTT is qualified, you can benefit from the QDMTT safe harbor. This means the global top-up tax is deemed to be zero for the jurisdictions applying a QDMTT, for any jurisdictions which apply top-up taxes. So if Switzerland has a QDMTT and meets the safe harbor, then the top-up tax is deemed to be zero in all the jurisdictions which apply income inclusion rule, under tax payment rules. And insofar, Switzerland is protected from foreign tax administrations, and in particular, Swiss multinationals or entities based in Switzerland are protected from audits in other countries. This is the reason that it's so important that we meet the QDMTT standard. So in the peer review process of the OECD, jurisdictions need to disclose their tax incentives, which are relevant for assessing whether an IIR or a DMTT is considered as qualified or not. And as soon as a country introduces regimes, incentive regimes, which violate the no benefit requirement, the qualified status is at risk. So Switzerland passed the transitional peer review. And this is not surprising because no single canton has introduced incentives yet. So we will see what happens in the future. This is the reason many cantons wait now for this admin guidance, because they want to be compliant actually. And they think even if the guidance will be issued, if Switzerland or cantons implement expenditure-based R&D tax credits, I think they would be still fine. They could afford that. And so this is the reason that they wait for the admin guidance before introducing such new incentives. So let's quickly have a look at regimes which are already in place. I would like to have a look at the refundable investment credit in Singapore. Singapore has adopted the Pillar 2 as from the 1st of January 2025, and therefore it hasn't undergone the peer review process. So we have no clue whether Singapore will pass the peer review process. Which kind of incentive do they provide? I quickly read it. The REC, Refundable Investment Credit, seeks to enhance Singapore's attractiveness for investments. The REC encourages companies to make sizable investments that bring substantive economic activities. Sizable investments that bring substantive activities. These two terms refer to thresholds that need to be met for qualifying for the RIC. And then substantive economic activities may refer to companies with residual profits. So it's a typical regime for investment hub. Switzerland would love to have a similar regime as well, but they didn't dare to propose something like that. And substantive economic activities to Singapore in key economic sectors and new growth areas. It will be awarded on an approval basis through the Singapore Economic Development Board and Enterprise Singapore. And then you see the RIC will support high value and substantive economic activities, such as investing in new productive capacity, expanding or establishing the scope of activities, expanding or establishing headquarter activities or centers of excellence. Commodity trading firms can also benefit, and of course, R&D and innovation activities and decarbonization measures. So, what is the problem here? The RIC of Singapore will be the litmus test for the OECD. If they accept this RIC, then I think Globe will be a joke. Every investment hub will follow Singapore's example, because this is exactly what we want to do. We want to incentivize multinationals with residual profit, and this is what this regime is actually about. There are some problems. There are thresholds. So the question is now, what does it mean, sizable investments? If the threshold is too high, of course, small and mid-sized companies are excluded from this regime. This means that the regime could impose integrity risks, which means that the Pillar 2 can get undermined. And the same is true with substantive economic activities. From a policy point perspective, it makes sense to have such a regime for an investment hub, but the main goal to tackle base erosion couldn't be actually achieved anymore if such regimes would be allowed and approved. But again, now we are in a totally different world. We have the US that wants to actually defend the US R&D tax credit. This is very important. They are totally against the arbitrary lines drawn by the OECD. They will heavily fight against these rules. Under these circumstances, I wouldn't be surprised if the Singapore regime would get the blessing of the inclusive framework, and I'm sure many investment hubs would then follow the example of Singapore. Let's have a look at some proposal in Swiss cantons. This is an example of a canton that I didn't advise. I must say that, and I'm glad that this is not based on my advice. This is a canton which wanted actually to set a threshold for the tax credit. you find that, the expenditure-based funding, this is good, but there is a limitation. This is what I highlighted here, maximum funding, 1.5% of the average taxable income of the last 3 years. Though they included a cap, which refers to the profit which was earned in the previous years. The idea behind it, it's clear. They just want to return taxes which they already collected in the past. This cannot work because we know profit-based incentives are bad incentives under the OECD global rules, but of course, good incentives with respect to a budget of a government because it limits your budgetary risk. But this is a no-go because this would lead to a reduction of covered taxes. And then you see the canton also proposed a measure for decarbonization, for supporting decarbonization measures. And you see, if you look at the description of the measure should only be applicable for a minimum reduction of 50,000 tons of CO2 equivalent scope 3 category 1 emissions. If you go into all the rules that need to be considered, you will find out that this measure is highly selective, and the purpose of this measure is actually to incentivize commodity traders. This is the idea. It won't work under the Pillar 2 world, and I think even if Pillar 2 will collapse, the EU will apply the foreign subsidies regulation. So this is one example. Luckily, this Swiss canton has not adopted this regime because they learned that this is highly problematic and they would put the entire Swiss adoption of Pillar 2 at risk, and they didn't want that. So maybe I have to come to an end, Gustavo. I think 2 minutes, just one point. We don't have to dive into the foreign subsidies regulation, but I think it's important that you know.
Please feel free, René.
Okay. I think it's important that you know that there is this regulation in place. The EU actually adopted this foreign subsidies regulation in 2023, and by doing so, they rolled out their subsidy prohibition, state aid prohibition rules. This is the exact term, the state aid prohibition rule to third countries. So this is really relevant. It's very relevant for Switzerland because Switzerland is a third country. It might be also very relevant for Asian jurisdictions, for Asian-based MNEs, which are also active on the common market of the European Union. It might be less relevant for US companies, I think, because they might get afraid of retaliations. So you see the world is changing. It's more about power than about law. But we, as lawyers, we have to take that into consideration, of course, as well. But now, which measures are problematic? Selective incentives are problematic. For example, like the one of Singapore. This is selective. Under EU law, all incentives which are granted upon discretion are considered as selective. So they might be in the scope of the foreign sales regulation, and then also incentives which actually can just be gotten by meeting a specific threshold. For example, if you have to meet a threshold of, let's say, 2 million expenditure on R&D. And this is problematic. This is considered as selective under the case law of the ECJ, of the European Court of Justice. So selective, problematic. And if they lead to a distortion of the European market, the EU Commission may pick them up and investigate them. And what is the consequence? And this is very important. If you violate the state aid rules within the European Union, the company which received the subsidy has to pay it back with late interest. So Apple is a famous example. Now you rolled this measure out to third countries. This means if the EU Commission comes to the conclusion that a company based in a third jurisdiction received selective incentives,
Mi,
they can
a gente não
ask.
tinha combinado uma petição de tipo 5 páginas?
Paula, put on mute.
Não tem como. Amor, lógico que tem como. Tipo, a única coisa que
Paula.
você precisa rebater é a liminar que foi concedida. Tipo, você fala assim, ó, para começar.
Just a second, Renê.
Como é que você tá fazendo? Não, aqui.
Paula,
nessa
Paula
parte-
Zugaib, Paula Zugaib, mute, please.
I have to speak up a little bit. Okay, but anyway, I have to come to the end anyway, I think. So I just wanted to mention that, and you also see that there is a limitation period of 10 years.
Então, me ligou sem querer.
So they can really
Oh.
investigate during 10 years and then get back the money. But again, this is a regulation which was put in place to fight against Chinese multinationals, actually. But we will see if Pillar 2 fails, whether the EU Commission is willing to apply this regulation in a much broader way. It can be, it cannot be, we don't know it, but this regulation is in place, is effective, and we should not ignore that. And it becomes relevant for multinationals that are conducting business in the European market. And of course, for Swiss companies, this is highly relevant. So which are the conclusions? I would like to sum up quickly because the time is already up. Thank you for the that I could a little bit extend the time. Now, again, I think I can just support everything what was said about the distinction between QRTC and non-QRTC. I fully agree. This is really something that shouldn't have happened and which really raises some fundamental questions about how these model rules were designed, which country designed it, and which self-interest they actually tried to defend here. And I think this is not good for an international forum. You should not implement arbitrary rules, and this really questions the legitimacy of the entire concept. This is really something sad in my view and very bad because I'm a big supporter of the OECD. I appreciate the people there. They are super smart. I think also the concept is really very interesting from an intellectual point of view, but there are some really nasty places where you can really see who was behind those rules. This just fits also to my observation with respect to the MTTCs. These QRTC were expanded to protect the green tax credits under the Inflation Reduction Act. So I fully agree. You should actually treat expenditure-based green tax credits or R&D tax credits similar, irrespective of whether they are refundable or not. If a jurisdiction just wants to limit the budgetary risk, and I think limiting the budgetary risk is also a very sound policy goal which should not be ignored, in particular also in the EU. And but in my view, the model rules would need to be amended in this regard. But now the shift in the administration in the US maybe also gives new opportunity, because now there's no consensus anymore in the inclusive framework, and the OECD has to take that seriously. And this may lead to negotiations of the global minimum tax. Then I also take the position that tax incentives available to all taxpayers should not be considered as a violation of the no benefit requirement, irrespective whether they have been implemented together with the adoption of Pillar 2. There are some very strange discussions going place. There are people advocating that refundable tax credits, which were already introduced before the global minimum taxation rules, that they are fine. They should be grandfathered in any way. And when investment hubs like Switzerland and Singapore introduces new measures because of the Pillar 2 world, then they want to check whether these measures actually are whether only MNEs subject to Pillar 2 benefit from these measures. And I think this is not in line with the case law. Irrespective of that, if the tax incentives are available to everybody, it cannot be a violation of the NB, or it cannot be that countries that introduce such measures later are under scrutiny and the other ones are protected by a grandfathering rule. So this is something that must be looked at. We already said income revenue-based, selective and discretionary incentives should only be recognized. I didn't say that where it can be demonstrated that SMEs can significantly benefit from them. I didn't explore that. I leave that out. And then, of course, it would be fantastic if the inclusive framework could release admin guidance on related benefits to give lawmakers some legal certainty, to give MNEs legal certainty. We have a situation, in my view, which is not acceptable. Then Singapore's RIC regime is interesting, and it makes sense from the point of view of Singapore. Singapore will be a litmus test. I said it already. Singapore will undergo the peer review in 2025. And if Singapore's get the status of qualified, then I think many people in Europe, in Switzerland, will be relieved because they would follow the example of Singapore. So, Gustavo, I exceeded the time a little bit. Sorry for that, but thank you very much that you let me speak. This is really very nice. And you see, there are so many interesting issues. I could speak the whole day about them. Thank you.
Thank you, René. You didn't see it at all, and thanks a lot for the real complete overview, and really your conclusions show the completeness of the review that you made, and how you really thought about this. I have some thoughts on it, but I don't know how you are with time. So
I'm
I don't wanna
fine.
keep
I'm
you.
fine. For
Yeah.
me, I think it's much better than for you, but it's really about you, and any questions are welcome.
Yeah,
And also have a
we'll
follow-up.
probably have some questions
Yeah.
from the people here.
Okay.
Just two thoughts.
Yes.
The first one about the non-benefit required, I fully agree with you. We do need to know where exactly will they draw the line. And I wanted to, maybe I lost a little bit during your presentation, but I wanted to check where you draw the line, because in my mind it was, well, you don't want a country to collect a QDNTT and then give the money back through a grant.
Yeah.
Okay, I agree with that, but will they go any further? How will they make the cut? And regarding Singapore, do you think it falls within the NBR rule? So I wanted to just see where the clash exactly is, and where does it turn into a forbidden return of what you have collected, or if it's something else. So that's one thing. The other, just a comment on the refundable. I do agree with you on the one hand that, protecting your budget is one thing that you should be allowed to do. On the other hand, if you look at the expenditure incentives, they are protective, one, by SBIE. Although SBIE, the 5%, the fixed 5% thing is not great. It should be variable depending on country risk. That is an argument that I have been making for some time. But second, you have the DTL rule, which basically, if it's an incentive on tangible assets, then you're fine. It's going to be taxed. It's not going to affect the top-up rate. It's going to be capped at 15%, not to shelter all their income, but it doesn't even fall within the DTL recapture rule. So you're fine that way. And if it's not on tangible assets, then you don't have the SBIE, you don't have the DTL rule. All right. But then if you're doing it for an intangible asset and you're dealing with expenditures, well, it really depends on the expenditures that you're dealing with, because if it's on wage, then the SBIE should, at least to a certain extent, protect it. And if it's not, well, then we'll need to check whatever the expenditure you're protecting, but you still can make it through a refundable credit and have some budgetary protection by capping the benefit, the overall cost of the benefit itself, meaning that when you reach a certain amount of subsidy, you stop giving it, and you could distribute it to some kind of first come first serve, or through another way to select whoever's getting the grant that is not based on profit. Because in the end of the day, if you do an expenditure incentive that is just a reduction of the income tax, even though it's not a profit incentive, it has a profit component, because if somebody is not being profitable, they won't get any money back from the incentive. So I think that in the end of the day, what they were trying to do was saying, well, you need to do it not based on profit, or if it's based on profit, it's either on tangible assets or on payroll, because then you have all the other protections. So I do get a criticism, but it's hard to come up with a better system or a different system, because otherwise I would be saying, well, you can do green incentives and you can do this and that. And I think that will be worse, because then the OECD would be the world police on what market failures should be protected. And I don't think they wanted to go that route. So just some comment, and I wanted to pick your brain on that. But the first one, I really want to know how in your head is the divide between what would be allowed and what would not be allowed between in that rule.
No, I think this is yes, absolutely. I can try to give you an answer. So I think the OECD commentary already provides some hints. If an incentive is granted to everybody, then it's okay. Then it's not selective, and then everybody can benefit, and there are no distortions among competitors. SME can be incentivized as M&E, and I think this is fair. This is one point. And then it's also clear the directive, you just give the top-up tax back to the MNEs, this doesn't function. But now, where should we draw the line? I mean, this is really difficult. I think at least if you grant the credit to everybody, no further investigation should be conducted anymore, because future taxpayers which don't fall under Pillar 2 might get the benefit as well. But I think the problem starts with selective incentives, and incentives which are based on a discretionary decision of a government. There, I just see a high risk that the global rules get and the policy behind it gets undermined. And there are now two solutions. The one solution is, this is the extreme one, you prohibit such incentives, which prohibit just under Pillar 2, which might go too far. And the other solution is that you ask for transparency with respect to such selective incentives, to check whether a significant amount of the incentives granted went to Pillar 2 companies or not. And then the question, of course, arises, which is a significant amount? 60%, if 60% of the revenue which was actually used to finance, to fund these incentives goes to Pillar 2 companies. Is this a threshold or not? I don't know it. But this is anyway a gray area which the OECD hasn't addressed yet convincingly, and it will become hard anyway to address that. And the NBR also applies to QRTC. So we have to distinguish this discussion about QRTC, whether the distinction between QRTC and non-QRTC is based on a sound policy, and the NBR. So even if you have a qualified refundable tax credit, you may get into troubles. This is the first question. And to the second question, I think it's important. I can follow what you say. I come from a jurisdiction, from an investment hub jurisdiction, so-called investment hub jurisdiction. And if I speak to multinationals and cantonal lawmakers, they are actually interested in promoting companies with residual profits. They want to grant to those companies with high residual profits, with IPs, R&D activities in Switzerland and around the world, the incentives. And this might be the reason that they are afraid of the budgetary risk, because if you really want to grant incentives which really help to attract those companies, the amounts are pretty high. Then sometimes we speak about billions that you grant. And then, of course, a measure like that, like the one that you mentioned, that you set a cap, won't work anymore and wouldn't be attractive anymore. And this is the reason that at least lawmakers in Switzerland and also MNEs are skeptical about such caps. But in terms of sound policy, I fully agree with you. I also agree actually with the fact that such incentives should be granted irrespective of whether a company is successful or not. The activity should matter, and if a government thinks that a specific activity is in favor of the economic development of a region, of a canton, or whatever, then they should treat all the taxpayer equally. What happens with profit-based incentives and with patent box? Just the big ones actually can benefit. Just the profitable ones can benefit. And for startups, there is no, at least in Switzerland, there's no instrument. There's no instrument for startups. And this means that you increase the threshold to enter an interesting market for small and mid-sized enterprises, which leads to a distortion of the market. This is the reason that there's some sound policy behind the concept of refundable, but then please, without time limit, without time limit. Yes.
And I don't see anybody with questions on your speech, but I do have questions on to René as a Swiss who is living in the US. So just have to understand a bit of first, what was the environment on Pillar 2 before Trump? How far were you going? Which were the expectations? Second question, after Trump, what are the expectations? How are you seeing this? Because of course you are in a unique position since you're Swiss, but you are in the US now, and I'd like to understand a bit how René is seeing this whole.
It's a great question. I think really it's now a game-changing event actually happened here in the US, in my view. I know that some people see it differently, but let me explain. Under the Biden administration, it was quite clear that the US recognizes the Pillar 2 legislation. Actually, they were even interested in bring the US tax regime guilty and be in line with Pillar 2. But of course, they were not successful because they didn't have the majority needed in the Senate. But at least I believe, because also the Secretary of Treasury, Ms. Yellen, always defended the Pillar 2 regime. I can hardly imagine that they would have threatened the other OECD members who adopted Pillar 2 and all the other members of the inclusive framework with retaliatory measures. So I think this is now something totally new. So the idea, I think we in Switzerland, we thought that the United States will recognize the Pillar 2 framework. And because of that, we also introduced UTP, QDMTT, and also IIR. QDMTT because we wanted to protect entities in Switzerland from IIRs levied abroad and also from UTPRs. And many US multinationals are based in Switzerland, and we wanted to protect them actually. And now, if the European Union is not, or the member states of the European Union are not able anymore to impose a UTPR, it may not make sense anymore to have an IIR. This means if it becomes clear that the UTPR will not be applied anymore in the future. There's no need for Switzerland to have an IIR. I think we would keep the QDMTT because of the IIR, because we don't want to lose revenue to other jurisdictions via IIR. However, now the situation is much more complicated, of course, because UTPR is part of the EU directive. And now the question is, what will the compromise between the US and the inclusive framework look like? Will they extend the UTPR safe harbor? Will they consider guilty as equivalent? We don't know it. The question how Switzerland will react is in the limbo. It's very difficult. But for me, the shift in the US politic is significant, I think, because they don't support this project anymore. The inclusive framework is consensus-based, and I think there must be a solution somehow.
So in summary, Switzerland has never adopted UTPR, so this is not a problem.
Yeah.
Switzerland has adopted IIR, and you believe this should be reviewed?
This should be reviewed if the UTPR is not going, will not fly. Will not fly means the UTPR will not be applied. For example, if the EU amends the directive, which is very unlikely because they need anonymous vote on that, and this might not happen, in particular if you see that they need urgent revenue to finance the defense. And so this might be difficult, but let's see if they come to the conclusion that they accept guilty. I think there's no need anymore for Switzerland to apply an IIR. Then it would be really actually detrimental for Switzerland as an investment location and as a holding hub in Europe.
Okay, René, thank you for this clarification. Does anybody have any question to Professor Matteotti? Yes, there's one question here from the floor. José Arnaldo is speaking now. He's getting the microphone.
Yes.
Hello, Professor. Thank you for your presentation. Here in Brazil, we have an income tax benefit. It's an income tax credit of 75% of the income calculated related to the development of activities in certain regions, Northeast and Northwest Brazil. This incentive, of course, will reduce the ETR of a constituent entity of M&E. And our current law, which introduced the QMDT, includes a provision that established that the government could replace such a benefit, called here lucro de exploração, with a refundable credit, which would, of course, meet the conceptual requirements to be considered as a key RTC under the GLOBE definition. Do you understand whether this change in the nature of the benefit would be deemed as a collateral benefit? And if the government guaranteed that such benefit would be granted to all the entities located in the region, not just the constituent entity of the MNEs, does your answer will change?
I mean, this is a really great question because it addresses one of the main discussion points at the level of the inclusive framework. So there's one problem here. This is really this what you mentioned, and the benefit is the incentive is income based. This is what I understood. 75% of the profit, if I understood you correctly. And now, of course, you can transform that into QRTC. This is something similar. What one of the Swiss cantons tried to do actually. And if it's income or profit or revenue based, there's a high risk that the inclusive framework won't accept that. The question is, if it's replaced by a QRTC which is expenditure based, then of course this is a totally different story and you should be fine.
So in
Yes.
summary, your diagnosis would be if Brazil follows this, we're going to face problems with the inclusive framework.
Yeah, it might be at least in 2024 you would got a problem, I think. And now in 25 the situation may change. The US wants to defend the R&D tax credit. I assume that they will speak to the OECD and they will not walk away like at the UN where they terminated the discussion and they left the table. I think this will be a little bit different because the US used to work with the inclusive framework, and I think it's in their interest. And so there might be some relaxation happening in the future. And I think this is something that, of course, will be discussed again. But if I look at the discussion which took place last year, my answer would be very clear, and I would say this is a problem. But I'm more optimistic when it comes to the future, actually.
Thank you, Professor.
Okay, any further question? Yes, there is one more question from Mariana.
Sorry. Hi, Professor. Thank you for the presentation. For all I got, I think the Pillar 2 is also redefining tax incentives all around the globe. We're here in Brazil, and I think this probably exists in other countries as well. We have a discussion in which we have some tax benefits that a lot of companies do have, and most of these companies are not subject to Pillar 2 rules. So we have to change all the tax benefits to become a qualified refundable tax credit. And most of the companies that use these benefits will have to be subject to these changes and these alterations, although they are not subject to Pillar 2 rules. So my question is, if from your experience, do you see another countries that manage to have some kind of solution for this, or it will be there's no solution and we'll have to change the tax benefit for all the companies, even if the majority of them is not subject to Pillar 2 rules?
This is a great question. So I think, if the company is not subject to Pillar 2, there shouldn't be actually a problem. So all the benefits are still working and irrespective of Pillar 2 because Pillar 2 doesn't apply. However, the problem is, and this is also something that jurisdictions will be exposed to, if you have some important tax regimes like patent box, which still works, which will still work for small and mid-sized companies, but not for Pillar 2 companies. And now you are going to introduce a QRTC, which is open to everybody. You know, everybody, then I think this should be fine. And this is something that the OECD has not decided yet, but I think it should be if MNE, a small mid-sized enterprise, can choose between the various incentives and can also opt in into a qualified refundable tax regime, I think this should be fine. Otherwise, it exactly what you said will happen. Jurisdictions will need to totally modify their laws with respect to the incentives. For example, if the patent box works for small and mid-sized enterprises because it's very attractive if you have residual profit, then it's clear that just MNEs will opt for a non-selective QRTC. This means, as a result, you have a factual selectivity. You have a factual selectivity because the small and mid-sized companies will choose the instruments which won't work anymore under Pillar 2, and the MNEs subject to Pillar 2 will choose the non-selective QRTC, even if it's non-selective. And I think the OECD shouldn't go so far to influence or to limit the discretion of domestic national lawmakers in this regard. They don't have the legitimacy, in my view, and they are, I mean, they are not the WTO. And so this is a very important issue that you raise and something that has to discuss thoroughly at the level of the OECD. And I take the position that you should allow both and you should not urge countries to totally reform their incentive regimes. Is the answer clear? I'm not so sure whether I was clear enough in this regard.
Yes, thank you. It's clear.
Yeah, okay, thank you for the question.
I don't see anybody raising his or her hand. So, René, I must come back to you just to thank you once again for your participation. You were very clear in your presentation and your ideas. It was very difficult to disagree from you, which is rare from my side. So thank you very much for your participation in this class and in this project the University of São Paulo is having for these 2 weeks. Goodbye. Thank you.
It was a great pleasure. Have a good evening. Bye-bye. Thank you again for invitation.
Thank you very much, René. So, picking up from where we left yesterday, I just want to say a few words about the provisions regarding temporary differences. So we left off yesterday talking about the allocation of the covered taxes, and we dealt with the cases. Let me see if this thing works. Okay. And we dealt with the allocation regarding CFC and CFC push down. Just a quick word, two things about CFC allocation. The first one is blended regimes. And what are blended regimes? The CFC push down assumes that you're going to tax each CFC separately, their profits separately, their foreign tax credits separately, and then you can perfectly allocate the CFC taxation to each CFC. But you do have blended regimes. And one example is the guilty regimes in the USA. The other example is our CFC regime, which you call it CFC or not, but we kind of blend all the CFCs that do have active income and tax the blended profit and give the blended foreign tax credit. So how do you deal with blended regimes? Well, the commentaries based on what they decided in one of the AGs, they deal with blended regimes. The problem is that it's a transitory rule, so we have a sunset in 2027. And the second problem is that they were created basically with guilty in mind. So they say that they were for regimes that tax lower than the minimum rate, lower than 15. And I don't know if they would apply or not for regimes that tax higher, which is our case. And well, one might say, well, this is not relevant because Brazil doesn't have IRR rules, so it doesn't matter. But it does, because Brazil can be in the middle of a chain. And you can have an UPE in a country that do have an IRR rule, and a Brazilian intermediate subsidiary, and then a subsidiary in the end that would be subject to Brazilian CFC rules. And for the purpose of the UPE IRR, Brazilian CFC rules should be allocated to the subsidiaries. And if there's more than one, and we do have a blended regime, and the Brazilian controlling corporation is blending the profit of the subsidiaries, the question would be if these blending rules would apply. I would say that there shouldn't be any limitation to it, but there is a question. So basically, I won't get into the blending rules in detail, but you are allowed to attribute the CFC on the CFC tax on the blended regime to the constituent entities that have a lower ETR. So the way that it works is that you get your applicable rate, which in our case would be 34%, which is our local rate, and then you subtract from the global jurisdictional rate on the CFC, and that will basically be the key for attributing more or less to each CFC. So it's a favorable regime because it allows you to allocate more CFC taxation to the jurisdictions that have a lower ATR. I would say that it should apply to the Brazilian regime, but it's not very clear on the commentaries. And it's also not very clear what they're going to do after 2027. The other thing is, if you have a limitation to CFC taxes on passive income. So if your CFC regime is taxing passive income, the reallocation of the CFC taxes to the constituent entity is limited to 15%.
If I recall correctly, there is a definition of CFC in Globi. I mean, there's a definition which is not what we have in Brazil. So you're trying to use an analogy here, and you might face some problem here because there is. I mean, one thing is okay CFC, but Brazil. If you get the Brazilian regime in the definition, I tested this once, and it was not at least matching completely.
You may be correct. We don't have time to get into that, but you may be correct. And then the question would be if we could allocate, if any, of the Brazilian taxation to the constituent entity. So that would be another problem. Okay, let's deal with the provision for deferred tax liabilities, because that is something that I don't want to finish without saying a word about. And the first thing is, does everybody know what a deferred tax liability is? What are we talking about? Because that comes from accounting, and that might not be clear for everybody, especially the lawyers. So yes, no, maybe. So basically, in a nutshell, you have a deferred tax liability whenever you have something that is on your accounting income now, and it's taxable, but it's not going to be taxable now. So it's excluded from the taxable income, but it's not a forever exclusion. So it's not something like if it's an exempt income that you're not going to tax now and you're not going to tax never. It's something that you exclude now, but you're probably going to include later. And why don't I simply recognize the tax expense later? Well, because your profit is now. It's already on your accounting profit. So you should recognize the tax expense now and create a liability for the tax that you're gonna collect later. This way, your tax and the profit that generated the tax on your books will be booked in the same year. Otherwise, you book the profit now, you'll say, well, there's no tax on it. Then you distribute it, and then later on you have a tax, and then, whoa, I distributed the profit, so I have an issue. So the liability needs to go together with the profit. And the decision that they needed to make on Globe was, would they, we're talking about adjusted covered taxes. So for current taxes, it's easier. You have a profit now, you pay the tax now, and it's on the adjusted covered taxes now. But for deferred taxes, the issue would be, should I compute it now, or should I only compute it upon payment? And the problem of only computing the tax when it's paid. So one solution would be, well, you don't care about the deferred tax liability that has been booked now, because I will only allow it for it to be computed on the adjusted covered taxes when the tax is paid, because then I'll have the assurance that I'm only allowing for paid taxes. Well, if you do that, you basically kill all tax incentives that are based on deferral. So for example, if I have accelerated depreciation or expensing, if I only allow for the tax to be considered upon payment, if I have an expensing regime, which would allow for me to get the cost basis of an asset that I bought this year and fully deduct it this year, and for example, on my books, I would be deducting in 10 years, because I would be depreciating as for accounting rules. Well, this is clearly a tax benefit that the tax law is giving, but it's a tax benefit that will be reverted in the future. So it's a cash flow benefit, which is super relevant, but it's a cash flow benefit. You're not exempting income, but you're deferring taxation of income. So this generates a deferred tax liability. And if Globe income doesn't take into account my deferred tax expense on year one, the year that I bought the asset and that I'm expensing everything, what Globe would do was a lot of top-up tax would be charged in year one and would completely kill the benefit. So they didn't want to do that. They wanted to allow this kind of benefits. So how do you allow this kind of benefits? Well, I consider your expense in year one. So the actual expense that I'm recording for deferred tax liability is considered in year one, the year of the recording of the expense, and not in the year of the payment of the tax. So this goes to your adjusted covered taxes in year one, in my example here. Well, but then they said, we cannot do as much as giving the full tax expense, because for example, if you have a country like Brazil, the tax is at 34%, and if we do an expensing regime and you give the whole thing a 34% value on that expensing tax incentive, then this might shelter other income that I'm willing to incentivize. So basically, if my deferred tax expense would be, for example, I bought an asset of 100. If there is an expensing regime, then there's 34 deferred tax expense that I'm giving now. That will allow for the corporation to shelter other non-tax income under the wings of this deferred tax liability that I'm giving now. So what they done is, well, I don't want to charge a top-up tax on that incentive, but I want to cap it. So they kept it at 15%, which is the Globe minimum rate. So it's just enough to neutralize Globe top-up tax on that incentive, but not more as to allow it to shelter other income. So that was basically the underlying reason. So that's why current taxes go into the adjusted covered taxes fully, but the deferred taxes have a different rule. And the main feature of this different rule is that it's gonna be capped. So what the rule says is, if you have a deferred tax expense, you're gonna count it in the year that you book the expense, but then you need to look at the rate. So if the tax rate is lower than 15%, you're gonna consider it at the rate. So if my tax is 10%, and the expense is 10, then it's gonna be 10 under the adjusted covered taxes. But if my tax rate is 34%, for example, and for example, I have an expense regime, I bought 100 asset, it generated a deferred tax expense in that year of 34. I would cap it for globe purposes to 15. So for under Globe, this would go into my adjusted covered taxes of year one at a 15 value, not at a 34 value, which is the value of the expense that I actually booked. So the first thing is that is a cap. There are other adjustments that we probably don't have time to go into, but the main feature here is this cap. And how do you do it? Well, you don't have only deferred tax expenses in here. You might have deferred tax revenues. Well, how does that work? Well, I might have a rule that requires me to pay tax now in something that I'm gonna deduct later. And the main one is tax losses. So if I have a tax loss this year and I have a book loss, because the tax loss can be compensated with taxable profit in future years, and in accounting rules, if I have an expectation of being able to compensate that, I will book this as an asset. What is the value of an asset, of this asset? Well, your tax rate, your corporate income tax rate multiplied by your loss. That's how much your loss is going to save you on taxes in the future. So you book that as an asset. And for non-accountants, that may be a surprise. You book this as an income tax revenue. So they call it negative income tax. So it's minus minus equals a plus. So you book it as a revenue, an income tax revenue. So for example, if I had 100 tax loss this year, I expect to recover it next year because I expect to have a taxable profit. And I'm going to book it as an asset, and I will book a 34 tax revenue. Is this allowed under Globe? Yes. And Globe goes even further. It says, well, if you have a tax loss and there's a possibility of you recovering it, and this can be discussed in Brazil because our recovery rules, our carry forward rules are capped, but they are allowed. You need to book the tax asset for Globe purposes, and you need to book revenue. And that revenue, that tax revenue, will diminish your tax liabilities. So as I'm putting here, if I have 100 deferred tax liabilities and 40 deferred tax revenue, tax assets, then I'll have an 60 to book. Yeah, sure.
It's a small question. Sorry, I have classes today, so just the question. I learned yes. I learned yes. This is violence. Hope it's recorded. Well, I've just made the surgery, I get this. Well, returning back, I learned yesterday that some expenses are not deductible for Globe purposes, and one clear is tax. I mean, corporate CIT is not deductible. So it's an expense which you add back. So my question is, now you correctly said that when you have the credit for losses, you have a revenue. This revenue should at least have the same treatment. That means you should disconsider this revenue for Globe purposes. But I don't recall having seen this in the list we saw yesterday.
Now, what it does is that it reduces your deferred tax liability. So So basically, you have 100 tax expense, deferred tax expense, and 40 deferred tax revenue. You book it at the net. So you book your expense on 60, but
It's more clear for me. I'm talking just a company which has a loss. He had a loss, nothing else but a loss. So he had a loss. I have the expectation of recovering this in the future. And you correctly said, well, in this case, you'll register an asset, which is the tax credit, and the revenue. My question is, this revenue is increasing my income in my balance sheet. And I should be allowed to deduct it, but I don't know this.
So, sorry.
I think, okay.
May I? Yeah, I thought you wanted to go as well.
Yeah, I think the corporate income tax is compounded by the current expense and the net of the assets and the liabilities deferred. So it's not the amounting of the revenue is not it's on inside of the corporate income tax. So when basically the rules rebalance the amounting and they recalculate the deferred tax to the 15% as a tax rate. So when the company report the profit, they considering like the amounts in 34%, the current and the deferred. But the Globi, okay, the current is okay on the 34% tax rate, but the deferred one you need to recalculate on 15%. So the amounting.
it's Paula, please.
No, I was going to say the same thing. So when you book a deferred tax asset, it releases an income, but not to your whole P&L. It releases an income that is booked against your current income tax provision. So the purposes of tax timing differences, and please be aware, I'm a lawyer, so I might be saying something that is not fully correct, is to normalize your tax rate. So you don't have something that is very big in one year and very low in the other. And this normalizes for financial purposes.
If
So
I'm
when you
understanding, if I'm understanding you both correctly, sorry, just understand. Gustavo said that I would book an asset against P&L. You say no, you book the asset against the
Yeah.
corporate tax provision.
Exactly.
Yeah, because
Okay.
it's not to your whole P&L.
Okay.
It's in a specific account that is the same account that you assessed your current and deferred income tax. So it reduces, when you book the tax asset, it reduces your income
We
tax
have
for
3
that
minutes
year.
now. Yeah.
Isn't that,
Yeah, go ahead.
is that makes sense? I'm sorry. Go ahead.
Yeah, no, go ahead, Paula. Shwedi was just saying goodbye. Because
So it
he's going to
reduces your
class.
income tax for that year, and for the following years, once you take advantage of that deferred tax asset, then it increases your income tax. So you're working the same account, all about determining your corporate tax for that year.
Mhm. Yeah, exactly. So it's answering Shwedi's question. It's not a taxable event under Globe because it's a below the line feature, and it just messes with how much cover taxes you're gonna get on your deferred attributes. All right, we have some examples, but we'll definitely not be able to go into that in 1 minute. So I'll leave the slides, and if you have any questions, you're free to reach me. All right? Thank you very much, guys.